Good afternoon, everybody, and welcome to our first ever Technical Tuesday. Whole point of today is to help you with technical patterns, understanding them, how to have a better grasp of them, how to build models of them for yourself. And the first pattern that we're going to be talking about today is a pattern that shows up all the time during earnings season. This is why I wanted to start with this particular pattern because it's relevant right now. So, the pattern that we're going to talk about today, and by the way, I'm going to switch over to the slide deck here so you can see. Short strokes, the pattern to watch out for during earnings season. Now, what I'd like you guys to do is to let me know where you're logging in from. If you're logging in from YouTube, if you're logging in from Twitter or X or Facebook, let me know. Type into the chat where you're watching this stream from. All that said, let's dive into these charts here. All right, so first up, before we get into anything else, a little bit about me and why uh, why you should care. Um, so for the past 15 years, I've been trading successfully. I've been trading for about 25 years. It took me about 10 years to finally get my bearings and start to trade well. The reason why I struggled for so long was because I didn't have anything like what we're going to talk about today. Today, we're talking about patterns and we're talking about models of those patterns. I didn't have any of that stuff when I first started out. So I was running around like a chicken with its head cut off. So once I finally started to build models and a number of other things, I started to trade better. But today's focus was talking about short strokes. Then I was an IBD meetup leader for about 10 years. Some of you know Investors Business Daily. They're fantastic. I love those guys. If you're familiar with Can Slim, you're going to learn a lot today. Even if you're not familiar with Can Slim, there's still plenty to learn. And just like I said before, type into the chat any questions that you have as we're going through this. I've also authored two books. The first is the Mara Mindshift Guide, Trading Beliefs Workbook. That's available over on Amazon. I also published the Trading Mind Wheel, 8 Essential Skills for Trading Mastery. That one's also on Amazon. And if you had asked me even 5 years ago if I'd be writing any books at all, the answer would probably be no. So go check out those books. And of course, the main thing that I'm doing here is coaching aspiring swing traders. So let's dive into the content. So short strokes. Why should you care about a short stroke at all? So a little about short strokes. A short stroke typically happens right after earnings. That's where you have that first giant spike up flagpole, and then it trades very tightly thereafter for about a week. Typically happens in leading stocks, and it also provides high probability, high reward to low risk setups, which for me is the A in Eagle. The short stroke is capable of producing runs of about 20% or better, and that's why it's a good idea to pay attention to these when they show up. So, three big things that we're going to talk about, and then we'll get into the Q&A. So first, we're going to get into the short stroke basics. Secondly, we'll take a look at some historical models of those short stroke patterns. And then you'll also be learning how to build your own model book, which quite frankly is the most important part of all of this. It's important to first see what other people have done. That's been a major key to my success. I didn't invent any of this stuff. What I've done is, like most of you, I imagine, gone off, studied other people, found out what works, and then once you find what works, you practice it over and over again. And eventually, what happens is you start to see some of your own stuff, right? Like maybe you learn a little bit from me. Or you've probably learned from other people like Mark Minervini or William O'Neill or uh, fill in the blank. And as you study these other people, you start to see that, oh, well, this person sees the same pattern, but sees it in a slightly different way. That's uh, building your own mental model book. What we want to do is formalize the process, because when you formalize the process, you'll be doing significantly better, as it took me 10 years to figure out that point. So hopefully you're a lot quicker than I am. So let's jump into some charts. Right. So the first one that we're going to take a look at here is an oldie but a goodie, one called BlackBerry. Remember those? So this one I actually found from investors.com. I went there. I looked up short stroke patterns, and this was, well, what popped up. And so I went through this pattern and I studied it myself. And I started to see, well, what was happening on or around this time that jumped out to me? A few things that you might notice here, right? The first thing, this huge move here on earnings. This actually ended up being the highest volume that it ever had. And price spiked up. That spike right there was up 50%. Right now, if a stock jumps up 50%, how many of you are buying it? Right? How many of you are buying it? How many of you, if you've studied Cancelem or Minervini or myself, would you take a look at that and say that that price is extended a little bit? It is, right? Go ahead, type into the chat. Don't be shy. Let me know if you think that this is extended or not. It's very extended after jumping 50% in a day. But just because something is up, that doesn't mean that we kick it off of our radar. What we want to do, especially after earnings, and there's so many stocks that are doing similar work to this, they'll trade sideways, they'll trade tightly for a period, and then if they are still nice like this, what they've done is they're giving us an actionable spot to try to play this. They formed a very tight area right in here where price is moving sideways. And so what you could do is take an entry either here or here and set your stop just below it, right? So it's creating that asymmetric reward to risk. That as traders, that's the thing that we're looking for. Isn't it? That's what we want. We want asymmetric reward to risk. And that's what the short stroke pattern is doing for us. Here's a look at it briefly. We'll take a look at it over on the weekly time frame, just so you could get a better idea of what happened here. So I'm not sure if this is the exact price that BlackBerry was trading way back when. I think that this is split adjusted, most likely, right? It's 2004. We're in 20 years ago. So I'm sure that this is split adjusted. But price jumps 50% in a week, then trades uber tightly right near its high. That's what we're looking for in a short stroke pattern. Huge run up, volume dries up, and it gives us that tight area. So when we go back, and now we're looking at this thing back on the daily time frame, you notice a couple of things too, right? As price is trading sideways, what happens to volume? Gets progressively lower. And then when price breaks out, it's doing that on heavier volume again. So that right away, this is giving us confidence that this is one that could potentially work. Now, what happens within just a couple of days? Price moves up, kind of gradually comes up, and then all of a sudden, price has this move back down, right? And depending on who you are or where you're at in this position, if price has already run up 50%, and then all of a sudden it starts to eke its way out, and then it starts to pull back, are you confident in this or not? Right? In 2004, I'm not even seriously trading it. I would get freaked out by that and dump it. I didn't know anything about technical analysis back in 2004. It wasn't until about 2010, 2011 that I started to take all this stuff serious. but price retests the pivot area back here, and then it's able to continue its march higher. Let's take a look at PayPal. Right? Actually, yeah, let's take a look at PayPal and then we'll get into building historical models. Right? Because again, the most important thing is for you to be able to do this yourself. Now, here is, yeah, here's PayPal. Right? Similar move, isn't it? PayPal, huge jump after earnings, up 20%, heaviest volume in 2 years on that move up. Then it consolidates nice and tight on the following week. Closes near its high. Volume is not quite half, but fairly close to half of what it was before. The difference with PayPal, and this is PayPal from May of 2020. This one I actually traded. This one here, you can see it broke out, but what happened on the breakout? Volume was on the breakout. Closed at the low of the range. Then what happened? The next day, price pushed higher and closes at the low of its range. That's a negative outside reversal day. Do you have faith in this thing or not? I wouldn't have that much faith if I'm getting whipped around in this thing. But at the same time, I also know that there's a few other layers of support down here. Few other layers of support. There's a bunch of things that we like to look at when we're looking at different patterns. And we'll get into that deeper in just a minute. But some of the things that I like to look at, and I hope you're taking notes, different moving averages, right? Fairly simple, fairly straightforward. I like to look at the 5 EMA, the 10 EMA. I like to look at the 21 EMA. All three of those are here. That's the 5. This is the 10. This is the 21. I like to look at all those. And then when price starts to push up, what's happening to the moving averages? The moving averages are catching up, right? So by the time we get over to here, and the time that we get to this day, this was a pretty nasty day. Negative outside reversal, heavy volume. And that's the heaviest volume that price had in about 2 weeks. But what also happened? Right, well, what else do you see over here? That 21 period moving average caught up to the low of the gap, didn't it? And now it's giving something where price could potentially be supported at the low of the gap, at the 21 period moving average, at the weekly low. Right? Well, one of the things that we love to do in trading, and I hope that you're following along. And if you do have questions, please type into the chat and let me know if you have questions, or at least let me know that you're alive out there. The thing that happens when we start to stack all these levels of confluence is that it takes more and more to break the pattern. It's just like if you were building a floor. And if the floor that you had, like you start out with one layer on a floor, and maybe that's okay. Maybe you could hold a little bit of weight, but if you can't drive a truck over it, could you? Well, if you start to layer more and more and more and more concrete on top of this floor, eventually it gets so strong that it could hold a truck, right? Eventually you could drive traffic over a bridge, right? That's what we want to do and have with our trades. We want to be able to build a bridge. And that's kind of what these moving averages are doing, aren't they? They are building a bridge. And they're able to support this heavier sell-off here, and price bounces right back. Let's consider some of the models, right? So, I want to share with you this spreadsheet. This is a spreadsheet that I typically share just with our members inside the Mara Elite premium service, but I thought I'd share it with you here today. Let me increase the size of this so that way you could see it. Hopefully you could see it. Let me know. Type into the chat if you're able to see this thing fairly clearly. Here's some outside noise. I apologize. Can you see that? See it okay? Let me go over here and check over uh, on Rumble. I see some people looking over at Rumble. Everybody's good? Perfect. All right. So this is what you want to do for yourself. You want to come up with your own version of your model books. Now, I like to keep it all nice and tidy in a spreadsheet. There's a number of different ways that you could do it. You could do it in a spreadsheet, obviously. You could do it in TradingView, some other charting platform. It's all good. You could even print out charts and keep them in a notebook if that's what works best for you. I like to do it in a spreadsheet. So, first thing, name the setup, short stroke. Next, well, where are you going to find this thing? What charts are you going to look at? What time frames are you going to look at? I like to look at them on daily and weekly time frames. How long should the pattern be? I say about 2 weeks. Now, if you're a stickler, and let's say that you're somebody that's a stickler, and you want to say, oh, you know what, it should really be just 2 weeks. And let's say that you see this model right here, and you're like, yeah, that's week 1, that's week 2, and that's it. I think that that's perfectly okay. However, sometimes you'll get a short stroke that overlaps weeks, where sometimes it'll have this first week over here will be week 1, and then it'll start to trade sideways, right? It'll start to trade sideways like this one here. Yeah, and you'll get this sideways action in the middle of the week, and it'll start to break out. I would still count that as a short stroke. A more recent short stroke, one that I happen to be in, and we'll see if this one works out, is VITL. VITL, huge run up right after earnings. Tighter action after earnings. Dry up in volume. So far, broke out successfully. Do we know if this one's going to work yet? It's worked so far, but I don't know if this is going to be a successful setup or not. All this stuff has to be managed in real time. But when did the breakout occur? The breakout started on Friday, May 17th. All right, so here's where it starts. And it's starting to break out there. Yeah, you still have that second week. Every once in a while, you'll get like a midweek breakout from a short stroke. And the point of why I'm going way off on this tangent here is that sometimes it'll be about 2 weeks. Sometimes it'll be little bit more. Sometimes it'll be a little bit less. The main thing is that you want to have that sideways move. This move right over here, back on the chart. You want to have this be 1, 2, 3, 4, 5 days, and then it's starting to break out on the 6th day. Somewhere in there. You really don't want it to be too much shorter than that. All right, well, let's take a look again at PayPal. Right, this was going sideways for 1, 2, 3, 4, 5, 6. Broke out on the 7th day. Sometimes they could get a little bit funky. Need to be prepared for that too. the next. And all these that we're doing here, all these are what I would consider the must-haves. So if it doesn't have this stuff, then it gets kicked to the curb. Why waste your time on setups that don't meet your base criteria? There's honestly, I think that this is where FOMO kicks in for a lot of people, where you start to see it and it's close enough, and then you take it, and then it falls apart. There's if there's something that your pattern must have, then that should be black and white. It should be either yes or no, very binary, and then if it doesn't have it, sorry, you kick it out. It's when we get to this stuff over here, the different boosters, that's where if it has it, great. If it doesn't have it, all right, fine. Yeah, placement and trend continuation pattern within a stage 2 uptrend. And then this over here, I'm going to add typically occurs after reporting earnings. So we're building this together. All right. Now, there's a few other things in here that can help out the pattern, right? These are the things that I like to highlight. This was part of what takes some of these patterns from good to great. Now, remember when we were looking at BlackBerry a moment ago, how it had that positive reversal bar? That was one of the things that helped it perform better. It's one of the things that helps give us that lower risk entry point versus PayPal. If you take a look at the two of them, right? Here's PayPal. PayPal starts to inch its way up, and then it needs to come back in to reset before it takes off again. This is also a reversal bar, right? So when you start to see these reversal bars happening, that's something else to pay attention to that could get you in at a low risk entry point. Again, if you take away nothing else, we're looking for low risk entry points. High probability, high reward, low risk. If we go back to Airbnb for a moment, we're taking a look at this. Notice how this is consolidating all nice and tight down here, and then you get the reversal, and then it doesn't come back to threaten. But over here in PayPal, it's inching its way above the pivot, and so it needs to digest a little bit more. If we know what to expect, and we know what to expect because we've studied the past, then it makes digesting some of this stuff a little bit easier, well, when it happens. So, so we spoke about PayPal. We spoke about BlackBerry. We even took a look at VITL. That's what I have for you guys for today. Let me know what questions you guys have. If you have any questions, we've got a bunch of people on here live. I appreciate you guys being here. We've got about 40 or so people watching live over on X. We've got a couple of people over on YouTube. Let me know what you think. Let me know if you got anything out of this. If we should continue this. This is brand new. And if you did enjoy it, make sure that you like, follow, subscribe. We also have a newsletter. If you're not already on the newsletter, get on our newsletter. marawolf.com/newsletter. It goes out several times per week. Lots of great information in there. Stay on another moment or two in case if somebody does have some questions. You want to see what's going on with some of these other trades here. All right. So Nvidia did well. Nvidia is the gift that keeps on giving, doesn't it? And this is one of the reasons why we want to learn chart patterns, learn historical analysis, and then simply make ourselves available for these patterns. None of this has to do with prediction. It's simply studying the past, seeing what worked in the past, identifying similar situations in the present, and then making ourselves available. When we make ourselves available, this can happen. I didn't know that price would be up. Well, what's up? Price up now from where we entered. We entered down here, and now price is at about a 23% gain, 24% gain. I had no idea. When I entered the trade, I'm hoping for the best, but I had no idea that that would happen. That's why we also set stop losses. With this, I was able to have my original stop down here at about, I think it was a little bit lower than that actually. Yeah, around 879. So about a 4.5% stop. See what happened with VITL. VITL, negative outside reversal bar today. Volume is a little bit elevated. Do you remember PayPal? We were just looking at PayPal. Do you remember PayPal? How PayPal had that wonky move, right? Let's bring up PayPal one last time because it was so good. Remember how it was eking its way up? Then it had the outside reversal bar, and then it pulled back in, tested support, and then took off again. Well, if we study this, what do you think is going to happen to VITL? What would you anticipate happening? Probably going to get some more downside tomorrow, right? I wouldn't be surprised if that happened. But because I've studied the past, I'm now in position to say, you know what? When I see this happening, it can happen soon after a breakout, especially when a breakout happens like this and it's just kind of creepy crawling its way up. Now if price pulls back, now I know how to handle it. It's not where I'm not going to not manage risk. You always need to manage risk in real time. But if price does pull back, I'm in position now to say, okay, perhaps it's pulling into an area where price could be supported. And if price is being supported, I can observe how it's doing on one of the lower time frames and then start to get in with much lower risk. Maybe I could add to this position if it does pull back to the pivot and get some support there. Let's see, well, what else do we have? Do one more. Yeah, here's a question from Joe. Joe is one of our members, asking about Burke. So earnings is on May 30th. Is there something about this name that would lead to buying before earnings? Yeah, earnings is on the 30th, right? So that's in 2 days. And I must have the highlighter still on. That's one thing that I always mess up. Well, in TradingView, I'll keep that little highlighter thing on, and then it doesn't let me click on this. Anyhow, so earnings is on Thursday before the open. I decided to start a position in Burke today. Joe was asking the question, well, why would I buy so close to earnings? And if you guys are thinking the same thing out there, type into the chat and let me know. Let me know if you would buy right before earnings. Give you guys a moment to answer. Here's why I bought ahead of earnings. The answer is very simple. Price is setting up. Simple as that. Price is setting up in this cup-shaped base. Gave a cheat area right down here. Price broke out. Price started to break out on Friday last week. Started to get some follow through today. You see the volume down here improving, right? Heavy volume on Friday, heavy volume today, relative strength outpacing the price action and making higher highs. The price action is fantastic. Now, let's say price continues to follow through. Right now, I'm up about 2.5%. It's possible that price gets up to about 5% tomorrow, giving some cushion. Then what? Then I have some options heading into earnings, don't I? I can either sell some into strength, and by selling some into strength, then, and Mark just posted about this, my friend Mark Minervini. Let me see if I can pull up his tweet because, again, I've learned so much from Mark through the years, and absolutely blessed to be friends with him in real life. He wrote the foreword to my book, The Trading Mind Wheel. Yeah, here's what Mark posted. And let's get the private messages out of the way. All right, so here's what Mark posted today. I hope you could read this. He's talking about a position in MU, but the same thing still applies, right? He has not sold any of his MU positions since he bought it and posted it on April 26th. He's added to it with the trade now at a good size gain. It opens his options up. He could sell some to finance the risk and free roll the stop. He could move the stop to break even and free roll the whole position. Profits give you options, losses don't. So take that same concept. You apply it to this, right? I'm up about 2.5%. That's not that I'm up a little bit. That's not a whole lot. But let's say price continues to follow through tomorrow and I'm up 5-6%. This is a stock that typically trades about 3% or so per day. Still a relatively recent IPO. It tends to move a lot on its IPO. So if price can move ahead of earnings, then I could sell some into strength and free roll the rest of the trade, have my stop down here in case the price does gap down and then reverse. Something else, many other stocks in the same space have done very well. Right? There's Deckers. What does Deckers do? They sell shoes, don't they? Same space. Here's what it did after earnings. Similar setup. I'm not trying to predict. I simply want to make myself available for the opportunities. And by studying history, by studying the past, we can allow ourselves to be open for the opportunities. So anyhow, that's it for today. Again, I hope that you enjoyed this. If you did, please let me know and perhaps we'll do it again. Whether you are here watching live or you're watching the recording later on, I'd love to hear from you guys. And I do respond to all the comments. That's it for now. Again, take care. Much love. God bless everybody.